Menika, pretty good set of numbers here.
Yes, Paul, it's a good set of numbers. I think there has been improvement across all of the metrics. There has also been a one-time gain, that boosted the net profit. But, their investors were well aware of that. The more interesting thing to look for is what this new year will bring for Indian hotels in terms of its continued room capacity expansion, its continued expanding footprint, and its focus on its budget hotel range, which goes by the brand name of Ginger. And to talk about all of this, we have the Managing Director and the CEO of the company, Puneet Chhatwal, joining us this morning. Puneet, let me start with what Paul mentioned right up front. The year is kicking off on a super solid note. Your hotel is hosting the AI Summit, or part hosting the AI Summit in Delhi. You're raking it in.
Yeah, we are very pleased to be hosting the AI Summit. And as we speak today, there is also a Global Business Summit happening at the same venue by one of your competitive channels. So all in all, that's the venue, the Taj Palace, for all important summits. And we are very pleased to have the two top properties under the Taj name and two others within what you call the heart of Delhi, the Claridges, as well as a Ginger in what you call the Lutyens Delhi or Chanakyapuri.
$30,000 a room for some select suites. That is, incredible demand and an incredible way to start the year, Puneet.
Well, I think a little bit of, guidance is needed on the $30,000. $30,000 is maybe what is being charged for some suites or deluxe suites. And even higher for a presidential suite, or let's say a Tata suite at the Taj. But that's not what a normal room is going for. The average rates
of course not.
For the rooms are good, but not 30,000.
All right. What is the prospect for this year before I get into some of the more specific strategic sort of moves that your company is making? How do you broadly view the demand situation, the situation with tourism and the arrival of foreign tourists?
Well, the first and foremost is the demand remains robust and continues to outpace supply. As long as that is the case, the ability to charge will remain with the hotel companies and with the sector. And that actually has led to a very good correction, because between 2009 till 2017-18, the rates were almost at similar levels and had not seen any growth beyond inflationary level. So I think that has helped the sector to grow rates. Number two, I think a lot more people are getting higher disposable income because of the higher GDP growth, which is propelling into domestic tourism demand. And more people are traveling, not just on business, not just on normal leisure, but a lot is driven by spiritual tourism. We saw a huge demand on the temple circuit in India, and that is not subsiding even this year. Number three, as India gains more and more importance on the global stage, a lot more delegations are coming in. So we had the British Prime Minister, we had the German Chancellor, we have the upcoming visit of the French President. So a lot is happening on the government delegations, and a lot more are expected to come this year. And having said that, with the addition of doubling of the number of airports in India, with the new planes coming in, ordered by both Air India and Indigo, with that kind of travel demand and the spend that the government has forecasted on the infrastructure and has been happening in the last few years, the demand is going to keep growing over the next 3 to 5 years for sure, if not for a longer period. I personally feel it's going to happen over the next few decades, but definitely in the next 3 to 5, demand will continue to outpace supply, and the sector is very well positioned to perform well.
Then by how much should we expect room rates to go up, Puneet? Because like you pointed out, demand is somewhere between, I think, 9 to 12%, but supply addition in the hotel industry is somewhere around 6 to 8%. Are we expecting a significant increase in room rates for those living in hotels in the country?
I think I don't get tired in guiding everyone that room rates is one very important pillar, but the second most important pillar, especially in the Indian subcontinent, is your food and beverage segment, especially driven by the wedding demand. There were 50 lakh weddings, which is like more than 5 million weddings that happened in the last quarter. I think that also drives a lot more of room demand and food and beverage. And the delegations that I spoke about. So anything which is double digit for a very high base like we have versus the rest of the peers in the sector is very good for our growth, and that translates into good profitability.
Puneet, I'm speaking to you from Sydney, and one of the trends we've noticed in Australia is a lot of Australians heading to Japan to take advantage of the currency, the weak yen. Now, we have a weak rupee as well. I'm just wondering if you've noticed a lot more inbound foreign tourists, and if so, how are you moving to capture that market?
The foreign tourist arrival is still having a lag as far as India is concerned, which I consider as a hidden upside for the sector. If that starts growing at a CAGR of 15 to 20%, as we have witnessed in other markets, with definitely a weaker rupee, but also the growing importance of India and the more and more visibility that India is getting also through the NRIs coming back home, I think that's an upside we look forward to, but we have not yet seen that.
Well, you also used to have property as here in Sydney, and you've since exited Australia. Are you looking at shrinking your global footprint globally, or are you looking to start re-expanding in global markets as well?
On the contrary, we have actually increased our footprint across various markets in the world. We just opened 2 hotels in Bhutan, in the Taj in Paro and Taj in Phobchika, taking our total number of hotels in Bhutan to 3. We have 3 in Dubai. We are just about to open a hotel in Frankfurt, Germany, in, let's say, next 30 to 40 days. And another 100 days following that, we'll be opening a safari at the Kruger National Park in South Africa. So all in all, we are under development with 2 hotels in Bahrain, 2 in Saudi, and we would love to come back to Australia. But with the real Taj brand, what we had in Sydney was not an ideal fit for the Taj brand.
So you've got a strong debt-free balance sheet as well. And besides the expansions you just mentioned, are you looking at any acquisitions?
Definitely, either directly or with our partners. I think we have found a sweet spot with a capital light model. That's why we don't call it asset light, we call it capital light. Wherever institutional capital is available and we could enter into operating leases with certain investments into the furnitures, fixtures, equipment to get a better look and feel of the asset, we would consider that in those mature markets.
I want to expand on that question that Paul just asked you, Puneet, and that is, what is the acquisition strategy here on? You've been expanding your international footprint. You've also been acquiring hotels here locally. You're looking to organically expand the budget segment under Ginger. So give us a sense of how many more rooms you're hoping to add this year across some of these categories.
Menaka, firstly, I think it's very interesting to see where we are coming from. We were a 150 hotels portfolio 7 to 8 years ago. Today we are 600 plus, 617 as we speak. So the portfolio has quadrupled. But more importantly, our focus has been on the Indian subcontinent with the different brands that we have, because staying true to our name, Indian Hotels Company Limited, given by our founder Jamshedji Tata, I think it's an obligation for us to grow pan-India and to maintain that leadership position. But when it comes to Taj, Taj is a global brand. It's a crown jewel of India. We are very happy to be present on the Fifth Avenue with the pier in New York. in San Francisco with a beautiful asset in London, which we keep investing every year into, and other gateway locations and markets where there is
Puneet, it would be useful. I'm so sorry to interrupt you, but it would be useful to know how many rooms you're hoping to add this year, and what investors can expect in terms of an expanded presence across categories and geographies. So, in very brief, how many more rooms, any new destinations, and are you looking to step up your acquisition strategy domestically?
We have 32,000 rooms in operation, 30,000 in pipeline. Every year we expect to add 6,000 to 8,000 rooms in operation going forward, which is approximately 20% growth in the portfolio as a base. And that pipeline is everything that is legally valid and already communicated to the market. And that should help us in our growth of top line as well as the brandscape as we go from quarter to quarter.
All right, more local acquisitions of hotels. I know you just disinvested some shares from one hotel company, GVK, but are you looking at, let's say, newer properties to buy within the country to be able to expand the destinations you have?
To consolidate our brands like Ginger, we added A&K Pride, and now we are about to complete on Bridge. Earlier, a year ago, we did Tree of Life as a new brand. So we have increased our number of brands from a few active brands to 10 brands, and we address all segments of the market. So definitely any acquisition that helps us to consolidate the presence of Ginger or Tree of Life, we will definitely go for it if it's an ideal fit. And definitely we'll never lose sight of improving the footprint of Taj.
Businesses in India, Puneet, are dealing with all kinds of significant challenges, from AI to new, sort of labor rules. What will be the biggest challenge facing your industry and your company this year?
The biggest challenge that we are confronted with is making our talent grow as fast as the portfolio is growing. We are put in a lot of levers in place from an educational, training, skilling, all perspectives. And that talent has to grow because of the ethos of service that we stand for, and how to quickly scale that up to address the needs and wants of different brands in different segments.
Okay, I have a final question on Ginger. I know that has turned out to be a significant growth element in your portfolio. Can you talk us through, sort of the kind of visitors you see the Ginger sort of range attracting, how you see that trend change in India of budget travel?
As you rightly said, budget or mid-market, we would call Ginger's repositioning more into a mid-market brand or a lower mid-market. And that brand addresses the needs and wants of anything between 300 to 500 million people, 300 million today, 500 in 3 to 5 years from now, from a population of 1.5 billion that is expected. So Ginger should be around 250 hotels at the end of this year, in at least 200 locations in India, whether it's metros, tier 1, tier 2, tier 3, tier 4 cities. And Ginger will definitely contribute in double digit to the total revenue and approximately operating at 40% EBITDA margins.
Puneet, just one more question. There is an implementation of a new labour code coming in India. Can you give us a sense of what it might mean in terms of costs and also operational flexibility?
If you look at our financial reporting, we have reported and taken a provision for that new labour code that is actually a progressive step. I think that was much needed, and the nation waited for a long time for this. We are very happy and pleased that something good is happening towards the labor in India, and doing that will ultimately help brands like Ginger and Tree of Life, because yes, in the short term, the costs go up by around 10 to 12%, but that is absolutely necessary for the kind of positioning India is enjoying as the number 4 GDP nation in the world.